Welcome to This Week in Money. I'm Jim Goddard. Today, John Kaiser of Kaiser Research is concerned the economic boom in China could go bang due to creative banking. Hard Rock Advisory Editor Eric Coffin calls India's new budget disappointing for gold. We'll talk to John Kaiser right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Sitting in for Phil Mackesy, here is Jim Goddard.
My guest is John Kaiser of Kaiser Research. Welcome to This Week in Money.
Jim, it's good to be on your show.
Today we're going to be talking about the junior markets and how a person can deal with them. They've been in poor shape for the last couple of years. And in fact, John, your latest blog talks about that. Maybe explain a little more about that and how people can get information from your site.
Well, my site's called Kaiser Research Online, simply kaiserresearch.com. And in the hot off the press section, you'll find a link to my big, long blog piece called Understanding the Junior Resource Sector Bear Market. And in there, I talk about the four core narratives that underpin the junior sectors and why they are stuck in a trap right now, about which neither companies nor individuals can do much to change the current bear market malaise.
Now, of course, we had the U.S. Federal Reserve believing that with quantitative easing, they could help people survive the crash and recover from it. But does that help a Canadian junior company at all?
Well, one of the core narratives is gold, and gold trending higher, ideally in real terms, is a major underpinning for enthusiasm for the resource sector. The idea that the United States needs to print less money because the economy is starting to grow has two implications. One, it means that interest rates will gradually start to rise, normalize again, which will make the zero interest earning gold less attractive and therefore not really give any impetus for demand. And the other is that the money printing, which is supposed to make gold go up in nominal prices, and the junior sector definitely responds to an uptrend in the nominal price of gold, that's also not supposed to happen. So all this supposed good news for the U.S. economy is not very helpful for expecting higher gold prices, which are needed to breathe life back into this sector.
Was it a shock to you that it's taken so long for junior mining companies to rebound when other sections have received a lot of investment? Or is it because high tech like 3D printing just captures so many more headlines than a hole in the ground?
Well, the core narrative number one was the super cycle that kicked in last decade with China coming on stream and catching the mining industry off guard. So we had copper go from 60 cents to $4, and it's at $3. Nickel went as high as $25 from a $3 base, and now it's back in the sort of $8 level. What happened was that the global economy grew at a pace that it had not grown for decades, and that suddenly forced mobilization of new mine supply. And the fact that the metal prices have not fallen back so big, that drastically since the peak, tells you, well, there is a big change that has happened. But costs have gone up in the mining sector, and we do have a good supply response in copper and so on, and iron. We are expecting these markets to be in balance for the next few years. So there isn't that excitement about, wow, how fast is this going to grow? How profitable are these operations going to be? We are in this consolidation phase where they overbuilt in some cases. They put lousy projects into production. We're in the rationalization phase, and this also washes over to the gold sector, where when gold was at 1,900 and going to 3,000, there were a lot of buyouts and construction started on projects that at $1,300 gold are basically going to lose money.
And there's no way you can counter it. Now,
I wonder, will gold companies keep it in the ground, knowing that eventually the price will go up? And of course, if you limit supply, that drives price up as well.
Yes, and there's going to be a lagged effect. I mean, if you're willing to be patient for 2 to 3 years, there will be an uptrend in gold prices. But right now, after a big takeover cycle from 2009 until about 2013, now those were done at sort of premium prices. Now we're seeing the cleanup phase where stocks have crashed down 80, 90%, and they're being taken, the better ones are being taken over at modest 50% to 100% premiums off bottoms that are 80 to 90% down from peaks during the past 5 years. And the bigger companies are selectively acquiring these assets and mothballing them as strategic projects for 3 to 5 years from now, when gold is back in a significant real price uptrend. And that's part of the tragedy that's affecting the juniors, is all this capital that went into these companies during the last 5 to 10 years. It would be good to bottom fish for them and just be patient, but this inventory is all going to disappear. And then we have a bit of a vacuum facing us in terms of advanced projects, because until we get gold back above $2,000 in real term, where those low-grade 0.6 to 0.8 gram per ton gold deposits become interesting again, there will be a shortage of product precisely when people are getting excited about the gold sector again. So the space will be in the intermediate to major producers. Those are the ones that have the best potential for upside. The juniors, the pre-production juniors, they may be stuck in a rut for quite some time.
If any are left to be stuck.
Yes, I mean, it's really dismal. 2 days ago, I walked through my entire list of 1,700 resource sector companies listed on Canadian exchanges, and there I see the financial condition, the stock chart, what the projects are. And it was a truly depressing exercise. 60% of the companies have almost no money or negative working capital. Those that have money have dreary projects where it's not very clear what's exciting at all. And of course, when you look at June's private placement funding activity, the resource sector attracted a level of financing that was so low we only saw it in early 2003, not counting the 2008-2009 market crash trough.
Does that mean there are still good bargains out there, but you better be careful, do your research?
You can do your research and find these companies, and you can bottom fish. And one of the ones that I really like, which has the keys to finding, Nevada's missing gold undercover, they have dropped below 5 cents, even though all their financings were done at 10 cents. And now the risk is those who are long these shares don't want to put any more money in. Everybody on the sidelines is saying, well, this is an exploration company, and until you hit something, I won't give you any money unless you do a big rollback. So the big risk right now with these juniors is, even if they have a good story, and you accumulate it at these, in the pennies, you may find a 10 to 20 for one rollback and then another 80% price decline. And somewhere in the next few years, the really smart money that has capital will come in, pick up the pieces, and reorganize it. So for retail investors, it's become a very difficult period, which is why they're more interested in chasing after a momentum play like marijuana or something like that, which has broad appeal and for the moment name recognition.
Are the medical marijuana operations skimming money that normally would go to the junior mining companies?
I would say there's always momentum money out there, hot money that likes to chase anything that has an uptrend and that taps into a broadly understood theme. I would say it's not taking money away from the resource sector, and there's only about 30, 40 or so companies that have announced their intent to get into medical marijuana or anything like that. I think it's going to be more a flash in the pan. It is an emerging business sector, but it is one that I believe is better suited for private businesses, not public markets, because the scale is not enormous, and you're not going to see large agribusiness type conglomerates emerging from, say, the venture capital juniors on the Canadian exchange. You'll see that come elsewhere, probably in the American markets.
And of course, right now, the way Washington State and Colorado have structured their legal marijuana business, outside growers aren't allowed to take part. So you either have to invest directly in Washington or Colorado and hope that your Canadian medical marijuana company does okay on this side of the border.
And even in Washington, everything is carefully licensed and heavily taxed at 25% or so, and they're implementing strict controls to prevent unlicensed marijuana from entering the legitimate distribution system. So you'll still see a parallel black market evolving, and that's not really something that a junior can talk about. I mean, they have to talk about the legitimate side of the business.
Right, and if the government pot stores charge more than the market wants to pay, then the black market guys jump right back in, right?
Yes, I mean the criminal dimension will operate in parallel, and it'll become more difficult to stop it. It'll be akin to smuggling, like rare earths are a good example in China. China has these 25% export quotas, so everything that you buy officially in China and ship abroad to Europe or North America, you're paying 25% more. So of course the locals figure out with offshore parties how to smuggle this stuff out and bypass the 25% surcharge and maybe only have a 5 or 5% surcharge. So you'll see something like that happening on the sidelines.
What does gold have to hit before people think, hey, this is the thing to be back in?
Well, we had a pretty good first quarter, and it got to 1391, almost breached $1,400, and there's over $1 billion raised and bought deals for advanced gold projects, and towards the end there, in late March, even bought deals are even being done on exploration discovery holes. But then it pulled back below 1,300. It's around 1,320, 1,330 right now. I think for people to believe it's real, it needs to breach that high earlier this year and establish a base above 1,400. Then people will become confident, well, that big washout that started in 2013 is over, and we're grinding back towards $1,500. I think in my mind, establishing a base above $1,500 is what's needed to get money really flowing back into both advancing existing deposits and exploring for new deposits.
More with John Kaiser next on This Week in Money.
Always consult your investment professional before making any investment decision. More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with John Kaiser of Kaiser Research. What are you seeing happening in China? Because right now, people are kind of confused. We hear the Chinese banking system is in danger. 40% apparently of new projects there are being funded privately and not through the banks. Is there a danger that they'll run out of money and somehow the Chinese economy is going to take a huge dump? And of course, when that happens, the rest of us suffer.
Well, the big boom that started in the last decade was driven to a large degree by capital investment. And in the last 5 years, a significant portion of it was investing in real estate, building apartments and so on a pace faster than these buildings were being occupied by Chinese tenants. And part of the problem in China is they have this ridiculous rule that you can't move into these urban centers unless you have a special registration. So they have a real estate bubble on their hands, and it's been further fueled by a shadow banking system, because if you have your money in an official bank, you can only get 2% or so maximum on your deposit. So there's been another parallel universe of structured products, and kind of like our securitized mortgage industry that we had here in the West, this has evolved, and this thing is now in danger of imploding. So a lot of the concern about, the super cycle type narrative where you're hoping for higher base metal prices and so on the next few years, that's compromised by concern that China's slowdown into the 6 to 8% range may end up even worse, could go into the 2 to 4% range, where definitely the compounding effect is no longer building the absolute amount of raw material consumed, and will definitely shift the economy away from sort of capital intensive construction that uses raw materials. So this is this cloud hanging in the background, and it would give the juniors a boost if the feeling emerged China is going to navigate its way past this problem with at worst a soft landing rather than a hard landing, from which the recovery could be a lot longer than would be good for the resource sector.
I know the long-term goal of the Chinese government, they said, was to turn itself from being an exporter of made products to a consumer nation. Is it possible, do they have the income there to turn themselves that way?
Well, it's a function of economic turnover, and they are now the second biggest economy in the world. And yes, they need to shift the economy away from dependency on exporting goods to other nations, especially since the Eurozone and the United States have pretty tepid growth rates, and even right here, I mean, we talked earlier about all this end of quantitative easing. There really isn't any evidence of organic growth in the American economy, and there is a concern that over here we have a bond bubble. When interest rates start to rise, bonds will come down in price, with yields rising much quicker than anybody wants, which could take air out of the equity market too, which to a large degree is propped up by buybacks and special dividends and even borrowing to buy stock back, borrowing at low rates, and not much money is being invested in building future productive capacity, because there just isn't a sense that there is a growth future for the younger generations in the United States and even in places like Europe.
Take a look at Sears. Their solution to falling sales has been to sell off their most valuable properties. So on paper, it looks like they're making money, but when you sell all your stores, eventually, what kind of money are you going to make?
Yeah, there's sort of like almost an end times mentality where you're just sort of trying to make the books and that look good in the meantime, but there's no serious growth engine. Though in the case of department store shopping, that has been hurt by the proliferation of online shopping.
And you wonder why the post office is going to be cutting staff. How do you get all those online products out?
Well, not that much actually goes through the poor post office. It goes through private shipping like FedEx and UPS. So the private sector has kind of picked up where the post office left off, and the post office is still delivering letters for 50 cents, 80 cents, and they've got to be losing money on that because the parcel business, which is more lucrative, is controlled by the private sector.
A push to have securities in Canada regulated nationally. BC and Ontario were on the first page. They like the idea. Now I hear Saskatchewan and one of the Atlantic provinces says that's good with them. But Alberta and Quebec are still holdouts. Why are they holding out? And is it a good idea to have one national regulator for securities?
Well, companies, it used to be, a lot of the juniors were based in Vancouver, and so British Columbia was the jurisdictions whose rules defined where the money came from. But now companies are headquartered all across Canada. They're want to draw from a broader pool, and it is a very, unproductive, inefficient to have to prepare private placement documents for each province. It would be better to have one single set of rules as to who is eligible to invest and what the terms are going to be than this fragmented situation that we have now. And of course, the Ontario Securities Commission, you didn't mention that one, it is the one that wants to be on charge, but it also has the least helpful rules in the system. So it's a bit of a tug of war between the different jurisdictions as to whose set of rules is going to end up being the one that dominates. And I'm not sure how they are going to resolve these types of regulatory turf wars.
Is the CSE more of a bargain, and is the TSX going to lose customers because it's cheaper, more affordable to use the CSE?
The TMX group, which is now owned by the establishment banks, it's adopted this hyper-regulatory role where their officials act as a super board of directors of the companies, telling companies what to do. They've created an enormous pile of regulations and all that. It's not their responsibility to make business decisions. It is their responsibility to make sure that all the information disclosed is correct, so that when companies do stupid things, the public can see this and remember never to give their money to a company with incompetent or treacherous management teams. The Canadian Securities Exchange does not have the big piles of the huge welter of rules, and is not now trying to tell companies what the proper way is to structure their deals and so on. However, it has the downfall that it is not a very liquid market, and it also has the history of this is where you go when you want to print an awful lot of paper for flimsy reasons, which you can then eventually sell to the public. And so companies would go there, and when it was called a CNQ, manufacture their paper, and then interlist on the TSX Venture, where there was the broader audience. It's possible that the Canadian Securities Exchange will clean up its act as it goes forward, because many companies are moving over there, but it's still an open question as to whether this will be anything but a big paper printing machine.
And we've heard so many comments recently about paper money isn't worth the paper it's printed on.
Well, the sad thing about venture capital startups is that they do not have any intrinsic value. But it's all about the potential value that, human effort, creativity, and that is going to deliver. And in the resource sector, we have had a problem that many of these management teams are pretend explorationists. They really have no idea how to generate a target that has a reasonable prospect of delivering an economic outcome. A lot of it has just been going through the motions, pretending to look for something, and this has also been a negative thing. There's probably 500 companies out there which have no business being in the resource sector, and hopefully they all turn into medical marijuana companies or so, and then gradually disappear and shrink the field to about 400 or 500 real companies with real management teams, who, by the way, in my view, they need to have working capital of at least $3 million, a float of $3 million, to be meaningfully active in the junior exploration sector. And most of them do not have that, including many companies that I personally think have extraordinary management teams with excellent stories.
And so often, too, the numbers can lie and not really tell you how good they are at managing their money.
No, capital flows in during boom times. It's very easy to raise. You have the momentum. You have big picture themes. But right now, the super cycle narrative is not there, looking good. The gold narrative is stalled. In the exploration sector, where are the big discoveries that have made people who hung in there and put up the money an awful lot of money that they can crow to their buddies about? There's hardly anything like that. And with no money coming into these companies, there's very little chance that some 5-cent stock's going to go to $50 and restore the faith that, yes, these juniors can find fabulous stuff if they have competent people and deploy the money correctly. So even though there's lots of smart thinking going on inside companies right now, going through old data, which is not very capital intensive, there is no real money coming in, because you have to generate new data through sampling, through geophysical surveys, and these days, because everything's going to be undercover, you need to drill holes that are simply stratigraphic by nature, where you're mapping the geology in the third dimension in order to bring targets into focus. And the capital to make this happen just isn't available, and that's the tragedy right now, is that we may see this sector just wither away.
And that would be a disaster for BC and the rest of Canada's resource sector, no doubt.
Yes, and of course the court system hasn't helped out by creating open season on extortion by First Nations in all these exploration areas where Whereas if it wasn't hard enough already, now it's going to be even more difficult to get any traction approvals for exploring in Canada. That's one reason I'm much more interested in a place like Nevada than, say, parts of Canada.
Has that court ruling really thrown cold water on investment plans?
Yeah, there was a lot of negative feedback when this came out, and it sort of said, well, okay, they're saying they already have the title. It's not just this title that's theoretically, which the feds eventually have to resolve. They said, you have it now. Now, everybody who had any sense was already in consultations and so on. But what this has done is that it's upset the balance where the local stakeholders had to worry about what would eventually come from Ottawa and what they were hoping to get from the juniors. Now the power balance has shifted significantly, and the only thing that might keep everything reasonable is the gradual realization that there's no money available. And unless people are very reasonable in setting up the framework for exploring areas, there will be no exploration done in these areas.
John, always a pleasure talking to you. Again, maybe remind folks where they can find out more information about your organization and sign up for it.
Thanks, Jim. People can go to kaiserresearch.com and look for the blog article, Understanding the Current Resource Sector Bear Market. Yeah, this thing that in Ottawa, I mean, technically it shouldn't make any difference, but it's apparently had a real dampening effect on everybody's enthusiasm, which was already pretty muted. In Nevada, the environmentalists are trying to sterilize most of the state, in fact, most of the Northwest, by having the sage grouse declared an endangered species, which means that anywhere that there is sagebrush is theoretically potential habitat, even though there aren't any sage grouse there. And so they're terrified in Nevada as to that this might actually happen.
And I guess they look north and see what happened in Canada.
Yeah.
If you're a common law nation, they take a look at court rulings in other countries to see what they did in similar circumstances.
Yeah, well, in Canada, at least, the negative pressure is coming from concerns involving human beings. In the United States, it's about some bird that is sparsely distributed, and they're using it as a strategy to sterilize mining and exploration in the U.S.
After the break, Eric Coffin on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is Eric Coffin, editor of the Hard Rock Advisory newsletter. Welcome to the show, Eric.
Thanks for having me again.
I think a lot of people are worried with equity markets doing some weird stuff now, and hearing about Portuguese banking crises and how that's going to affect the entire globe, and how we know everybody's connected. What's that going to do to the overall metals market?
Well, I think anyone who follows the major equity markets is expecting a correction, at least. I'm not personally expecting anything worse than that. I think that's all we get. But certainly anybody who's watching those markets knows we've had such a long period without even a 10% correction that it's simply rational to expect it to happen soon. How much that directly impacts metals? It would probably be a little bit harder on the base metals. It would, if you had just a correction that wasn't sort of steep and deep and scared everybody so much that everybody just ran into the treasury market. A correction would probably be positive for most of the precious metals. I would expect it to drive a bit of buying into them. You saw that the other day when the Portuguese bank issue came up. There was a pretty good bounce in the gold price. You could see people decided they wanted a bit of safe haven buying.
And it's funny how gold was unpopular for a long time. In fact, we had people like J.P. Morgan and Sachs telling people that gold's going to drop below $1,000. Why even bother with it? Was that a strategy on their part just to snap up cheaper gold?
Well, if you're cynical enough, especially when you're dealing with an organization like, say, Goldman, which is fairly famous for trading against everyone, including their own clients, apparently, it's certainly possible. I think part of it is, the thing with Wall Street is guys on Wall Street are convinced that Wall Street's the center of the universe, period, paragraph, in all things at all times. And the truth of the matter is, when you're looking at the gold market, especially medium-term time horizons, it's not going to be Wall Street that decides what the gold price is. It's going to be effectively retail buyers, especially in Asia, that are going to determine where the gold price settles. And guys like Goldman can pound the table all day long, but the truth of the matter is, if people in India and China decide they're buying 2,000 or 3,000 tons this year, next year the price is going to go to a couple $1,000. It doesn't really matter what Wall Street thinks.
So China is still continuing their massive push to buy every scrap of gold they can find on the planet.
It seems that way. There's a lot of different numbers come out. I think the official gold.org number is about 1,000 tons. I've seen numbers from a couple of other sources who essentially look at what gets withdrawn from the Shanghai gold market, because at least until recently, the way the Chinese gold market was constituted, you basically had to sell through Shanghai. You had no choice. Those guys, based on that, they make the assumption that the true volume is actually the withdrawals from the Shanghai market, which is actually like 2,000 tons. I kind of suspect their number is more accurate, because that helps account for the 400 or 500 tons that China produces itself, and then what it's importing, and that that's drawing a lot of gold out of the world market. I mean, they're China and India collectively, even with India having all of the restrictions on gold imports, they're buying more gold than gets produced every year, and eventually that's going to have an impact.
I was just going to ask, has the new government in India made any moves towards easing their restrictions on the import of gold?
No, they had a budget yesterday, I guess it was, our time, day before their time. There really weren't any changes in terms of the 80-20 rule, where any gold that jewelers imported, 20% of it had to be re-exported, or the gold tariff, which is currently sitting at 10%. I would say, frankly, that budget seemed to be a bit of a disappointment all around. Everyone was surprised that they really didn't do anything very bold or decisive. It was really almost a carbon copy of the last government's budget 6 months ago, which is surprising, because really, I mean, the Indians gave the guy a mandate. They gave him a majority, which doesn't usually happen in Indian elections, and the expectation was this guy was going to take that majority and say, well, okay, you guys want me to make some changes, here they come. He didn't really do it. But I found it interesting that there was not, and I think a bullish sign, that there was not actually a negative response by the gold market when traders realized that there weren't any pleasant surprises in that budget. The gold bugs didn't get what they want, but they didn't sell anyway.
And if there were going to be tougher measures in a budget, usually that's the first one the government does, because they know an election is a long way away and voters have very short memories.
Yeah, if they're gonna be bad guys about it, you would have expected them to do it in this budget. I mean, the biggest problem with the Indian budget is that they do a lot of subsidizing. This has been going on for decades. There's a lot of subsidies of fuel prices and gas prices and some food prices, and there was some thought that they might start reducing those to cut down on the government deficit, but they didn't really do much of anything. It was actually a pretty boring budget.
China, always the mysterious giant, anything from there that hints on what their plans are using precious metals?
I don't think it's no big secret that the Bank of China, their central bank, has been accumulating bullion. They haven't actually updated their own number for 5 years now, or close to it. I think if you saw an announcement out of them saying, yeah, now we've got, whatever they have, 5,000 tons, 10,000 tons, whatever it is, if it was a big number, I think that would have a very large positive impact, because traders would assume whatever they own is not coming back into the market. I don't see any reason why they'd be coy about it, other than that they are, in fact, still accumulating stuff. Because most central banks, they'll put out their gold holdings once a year or twice a year. It's just part and parcel with all our other reporting. It just gets lumped in with everything else.
We all watch gold like hawks. What's happening with silver?
Silver got hit a lot worse than gold did. I mean, it's dropped from the 2011 top, and the 2013 top especially it was much more severe than gold was. I mean, the silver topped out at 50. It went all the way back to about 18. But percentage-wise, so far anyway, it's probably had a slightly better bounce. It's already up to about 22, so it's had about a 20% bounce, which gold hasn't quite gotten to yet. And there has been a lot more, you've seen a lot more buying in the futures market, and you've seen a lot more short positions coming off in the futures market on silver. There's actually been more changes in the positioning in silver than there has been in gold, and a lot of guys that are silver bugs are actually expecting a bigger percentage move in silver because it really looks like a lot of people have positioned themselves for that move.
We'll have more with Eric Coffin next on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking to Eric Coffin, editor of the Hard Rock Advisory newsletter. Eric, we were just talking off air about what you thought was going to happen this year with the venture exchange. Have your predictions come true?
Well, so far they have. My call at the start of the year was for a 30% increase in the venture index, and I'm just using that as a benchmark. In some ways, GDXJ is a better benchmark, really, but that's the one I picked in January, so I'll stick with that. It's up about half of that amount now. I think we are going to see that 30% increase. I don't think it's going to take much more move on the part of gold. We're almost back at the March high, the venture head before things fell off after the PDAC, and I think when we get through that, I think that's going to probably trigger more buying. I think the fall's actually going to be pretty good. One thing that encouraged me particularly in the last couple of weeks is not only have the gold and silver prices been increasing, but you've actually seen pretty good moves in most of the base metals, better than I would have expected. I wasn't expecting to see that this fast. Zinc's at a 3-year high already. Nickel's trading extremely well, although in nickel's case it's specifically because of the problems with concentrate exports in Indonesia. Indonesia put a concentrate ban in place starting January 1st, and it's actually a really big nickel importer. It's all kind of mom and pop laterite mining. But that, even though the nickel inventories in the London warehouses haven't dropped much, and the nickel price has gone up quite a bit. So you've seen the base metal index. It looks like it's had a strong move, broken through a 3-year downtrend. And I think that's a pretty good sign because, there's not as much, political buying or anything like that. A lot of those metals, they don't really get traded other than for strict supply and demand reasons. They don't get attached to, financings and things like that. So I think seeing that index in particular move, even though it's got a long way to go, is a pretty good sign.
Copper. I know some Chinese investors were using it as a hedge earlier in the year, kind of the way some people use gold, but that backfired on them. Any signs of anyone trying to do that again?
No, I gotta say copper's been a head scratcher for me personally, because if you look at the inventory levels, basically the combined inventory levels in Shanghai and London, it's really impressive how much the copper inventories have dropped in the last few months. Unlike a lot of the other base metals, most of them are just sort of back to what would be normal or even high normal for warehouse inventory levels, whereas copper is actually really low. And that, to be honest, it surprises me a bit given the growth rate that's reported in China. I would have expected copper inventories to drop slower. I'm one of those guys who's a little bit paranoid, and I wonder whether some of that copper that came out of the warehouses isn't just sitting in an unbonded warehouse and not getting counted, and it's available to kind of get dumped into the market. But if it is, whoever's holding it doesn't seem to have any rush to do any selling, and copper's actually trading really well. So I can't really ignore the way it's trading. It's back to 3.25. So apparently nobody's as worried about that as I was.
Zinc has gone up in price simply because in 3 years' time, most of the major zinc mines will be closed because they've run out.
Yeah, a couple of large ones have come off in the last 18 months, and there's a couple of more large mines will be depleted over the next 12 months. Zinc is one of those metals that just isn't that sexy, and it's not easy to attract exploration capital for that, so it's not something that many companies have focused on, and there isn't a huge amount of it in the pipeline. China's a very big zinc producer, but a lot of the zinc in China comes from relatively small operations that are, one, they're very inefficient, but two, they're also very big polluters. And I think Beijing is quite serious about cracking down on that stuff. And you combine those things together, everyone's been expecting a zinc supply deficit to start in, 12 to 18 months. The thoughts was probably closer to 18 months, but the way zinc's trading right now, I don't think it's actually going to be that long. It's already back through $1, and that's the best price it's seen in 3 years. And I know anecdotally from talking to contacts in the industry that smelters that smelt zinc are being very, very aggressive about trying to do deals with companies that are producers or near-term producers of zinc. They really, really want to concentrate. They're clearly quite worried about getting their hands on supply a couple of years down the road.
Do you see some of these hard-pressed junior mining companies switching gears and heading towards growing medical marijuana?
I have seen a bunch of that. I mean, to me, it feels a little bit like a flash in the pan. I mean, I'm not sold on the market size that a lot of these guys are talking about. I mean, I think when you look at the medical marijuana market, I mean, really what these guys are trying to do is position themselves for marijuana being decriminalized. I don't think the medical marijuana market is actually big enough to sustain, 20 or 30 or 50 companies that pop up and try to supply the stuff. So really, if you're betting on that, you're either betting on one or two really efficient, successful companies that will be the obvious target for a takeover if and when marijuana is decriminalized, or you're strictly understanding that you're playing a momentum play, and those things do work both ways. I mean, I've seen a bunch of these stocks fall hard in the last little while because Health Canada has started issuing the new licenses. They basically pulled everyone's licenses, and they're basically letting new licenses, a smaller number of them with larger capacity. And I know of 2 or 3 companies on the venture that were touting this that didn't get a license. So I don't know what they do now.
Do you predict a bubble there then, like we saw with the high-tech sector back in 2001?
Yeah, I just don't think the market is that large, really. And I wonder, when you there's this assumption, or there seems to be this implicit assumption on a lot of people promoting this, that if a bunch of states and a bunch of provinces say, or it would really have to be national in Canada, decriminalize marijuana, will the marijuana market get bigger? Well, yeah, probably it will. I'm sure there's people that don't buy the stuff now because they're concerned about it being a felony. But will the profit margin stay as high? I have my doubts. I mean, if it gets decriminalized, it's going to be subject to the same open competition as everything else. And I suspect most of these companies just aren't going to have the margins that they're fantasizing about. There'll be too many competitors.
Eric, is there a website people can go to find out more about your newsletter?
Yes, if you go to hraadvisory.com, all of the editorial from the journals that comes out every couple of weeks get posted there free of charge. And you can take a look at the track record. You can look at some recent issues, and we've usually got some kind of a sale going on. And the best way to get that is to just sign up on the website, because generally if we have some kind of special pricing, it's really just sent out to people that have added their name to our list.
Eric, thanks a lot for speaking with us.
Thanks for having me again.
Thanks to our guests, Eric Coffin and John Kaiser, and thank you for listening. I'm Jim Goddard for Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.